Hello, everyone, and welcome. In today's session, we are going to cover three key things that should be on the radar of everyone. And you will see on the next set of pages that the first thing that we want to touch upon is the top trends, which is shaping the location and workforce strategy. The second theme that we want to discuss is a practical playbook for sourcing leaders like you to make the right location choices. And finally, we will wrap up with a few key takeaways from today's webinar and also open it up for Q&A. But again, feel free to share in your questions over the chat during the course of the webinar. We will try to answer as many questions as possible during this entire course. But before we dive into the trends, we wanted to run a very quick poll to understand what our audience thinks for today's webinar. So the first poll that we have over here is that we have listed a few areas where we believe your workforce and location strategy is currently focused on. The first one is rebalancing your current shoring mix and exploring increased offshoring. The second option is mitigating rising concentration risk. The third one is diversifying into tier 2, 3 markets, low cost location. And the fourth one is transforming from the traditional hub and spoke delivery model. So you can select all of the options that apply to you. And I'm also seeing the results in parallel. It seems all the four themes are very pertinent right now. That should be on the radar. So let's see what is coming out as the most important one. It seems the first and the third one, actually the fourth one as well. These are the most pertinent themes that are coming out. And yes, so we have the first, third, and fourth theme have been classified as the most important themes, with the second theme being slightly behind than the other three themes. But it clearly showcases that, yes, all the four themes that we listed are critical in today's location selection decisions. This also reinforces the importance of taking a multidimensional view of location strategy. Now, with that, let us jump into the first major trend for today, which is offshoring momentum, which continues to grow. The four themes we discussed where offshoring continues to grow, rising concentration risk, organizations expanding into tier 2, 3 cities, organizations gradually evolving their traditional delivery models. And the most hits were for the first theme that we wanted to discuss, and that's where we wanted to discuss that as the first one as well, was offshoring. Be it enterprises, service providers, all of them have increased their offshoring percentages significantly. And we have some numbers on the next page as well, for example, which shows that offshoring is growing. It continues to grow, and not specifically only for service providers, but also for enterprises. Now, this is a trend that hasn't just appeared in the last couple of years. It has been building over time. We have given a view since 2018, and it clearly showcases that this has been happening over time. And what we are seeing recently in the last 3 to 4 years is more of an acceleration rather than a new shift. Now, the question is, why is this shift happening? The primary reason is a large talent base, which some of these offshore locations are able to provide. The large scale of talent, for example, be it any enterprise service providers, they have some of the largest centers in the offshore geographies. And that's why they also call it as offshore hubs. Couple that with the need for cost savings, and especially in the time when there is so much of a cost pressure out there in the market, and then also building a robust BCP, as in your business continuity plan. So all of this, when taken together, offshore makes a very compelling business case for itself, and that's where enterprises and providers, both of them, are channeling themselves toward. Now, the natural question that follows after this is that, is this wave expected to continue? And the answer is yes. And what we are seeing on the next page, we also have that it's not going to increase at the same pace as we saw in the last 3 to 4 years. We are likely to see increase in offshoring, but it is going to be selective offshoring. The focus will be on specifics. For example, within IT services, likes of tech support, cyber security, even tech consulting, product roles will move towards more offshore geographies. Within corporate support function, let's say corporate communication, corporate IT, finance, HR, sales, and marketing, these are the roles that we believe will see an increase in offshoring. And even services beyond your traditional IT, BP, corporate support function, the likes of ESG, risk and compliance, these functions will see more and more increase in offshoring. Now, that was one segment that we wanted to touch upon, the first trend, which was that the offshoring will continue to increase. The second trend that we wanted to touch upon is that, hey, that your offshoring is increasing, but it is also leading to a lot of concentration related challenges, which have become a critical boardroom agenda. And we have taken India concentration over here because most of our members and clients we speak with, they all start thinking that, hey, we cannot move outside India. So tell me about India plus one strategy. So starting with how the concentration risk is becoming very important, especially in case of India. Now, on the next page, we have some quantifiable data as well. What we have done is taken a 5-year view across different models, across different industries, whether it's global providers, India heritage providers, Big Fours or GCCs or global capability centers. All of them have increased their presence headcount in India as their core delivery hub. And this trend is continuing. Even, for example, you're seeing Indian pure plays sitting at around 74% of their headcount in India, compared to, let's say, Big Fours have 30% of their headcount in India. This trend is expected to continue. And that is coming from the previous set of pages as well, where we were saying that offshoring will continue further. So this trend is expected to continue again. Now, from a talent cost resilience standpoint that we were speaking in the previous set of pages, this makes a lot of sense, that move as many work streams to offshore geographies, bring it to India. But we also need to ask, are we becoming too reliant on one country, one geography? And that's where what we wanted to highlight on the next page is that India will continue to be one of your largest offshore destination, but what we are seeing now is shift in thinking. Most firms have now come to a conclusion that your offshore delivery model has to be India plus one strategy. This doesn't mean replacing India. When we say that we want you to rejig your entire concentration mix, we are not saying that replace India, but it means de-risking and complementing your footprint in offshore geographies with some of the key mitigation levers that you can probably use. For example, diversify, city diversification within India itself, which is one of the most prominent themes that we have seen many enterprises and providers used. Even cross-shore diversification, as in adding more nearshore and offshore locations. It can be stronger knowledge management practice. It could be agile delivery models to reduce single point dependencies. But in general, the key message over here is that for sourcing leaders, it's becoming increasingly important to actively track and manage these concentration risks, especially as delivery footprints grow beyond your traditional hubs. Now, with that, we wanted to move to the third trend for today. And for that, I would like to invite my colleague Harshit to take through the next set of trends.
Thanks, Amit. So as you outlined some of the key actions sourcing leaders are taking to mitigate concentration risk in India, it's a great broad-based growth across markets. A closer look reveals that Tier 1 locations are still dominating the demand, which usually results in greater market congestion, higher competition for talent, and rising attrition levels, all of which are the top of the mind for enterprises today. If we go on to the next slide, we've analyzed 7 leading offshore and nearshore countries, each representing a regional hub for global service delivery. Now, the visual here summarizes the key indicators that impact sourcing decisions. So here, the man with the arrows icon represents the tech talent attrition levels. The haloed figure represents the wage inflation in LCU terms. And the box icon indicates the total global services talent employed in each market. Now, here, two insights really stand out from this analysis, which is that both high attrition and rising costs are global concerns. And this is not limited to any one region. So while markets in India and Philippines show slightly higher figures, the sheer size of the talent pool and local currency depreciation helps moderate some of these impacts. But overall, firms across regions are facing challenges in both attracting and retaining talent. Now, in response, organizations are taking action. They're enhancing the employee value propositions, offering competitive pay and pack benefits, promoting hybrid and remote work, and investing in employee satisfaction to combat these challenges. So, yes, we're talking about high attrition. Yes, we're talking about high wage inflation. And yes, we're talking about market saturation in tier one hubs, which brings us to the next slide, in which we have highlighted that due to congestion in tier one cities and the ongoing uh, talent wars, we are observing a strong and growing interest in tier two and tier three locations. Uh, Now, this is a trend accelerated since the COVID-19 pandemic, and this is happening globally, not just in traditional markets. Let me walk through a couple of examples as you could see on the screen. In APAC region, places like Coimbatore, Bhubaneswar, Kochi, and Ahmedabad in India, Cebu and Davao in the Philippines are seeing serious activity. In Latin America, Querétaro and Tijuana in Mexico, Londrina in Brazil, and Medellin and Cali in Colombia are picking up steam. Now, Europe has particularly been active. In fact, Europe witnessed the most significant traction in tier two cities with Malaga, Dansk, Klug, and all showing strong momentum. And the trend is pretty much clear. Tier two, three cities are becoming the strategic choices for global services. If we go on to the next slide, what and then you and seeing that, you the natural question that you all must have is, what are the reasons for the growth in this demand in these locations? So I'll talk about some of the key big factors. One is low attrition. So tier two, three cities consistently report 2 to 4 lower attrition, and in some markets such as India, this gap even widens more. Second is the need for diversification and to leverage the untapped talent at incremental cost savings over tier one locations. Third is many of these places have now become have solid education systems and a growing infrastructure for global service delivery. Fourth is that some of these locations provide flexibility for existing employees to work from or closer to their base locations, especially post COVID-19, when a large chunk of the workforce has migrated to tier two and tier three cities. And lastly, in many cases, governments are also offering incentives to invest in these areas, which definitely sweetens the deal. I recall one of the leading professional services firms expanded their presence to tier two locations, including setting up their new technology development center in Coimbatore and another in Bhubaneswar in the last couple of years. And they had plans to hire 1,000 FTs in that center. This firm has been setting up centers across tier two, three cities in the last 2 to 3 years. And why? It is to tap talent, which is the large talent base, providing more flexibility to the employees and to tackle soaring attrition levels. Now, this is part of their bigger plan to double the India headcount over the next 2, 3 years. And tier two, three cities are central to that. There are numerous similar examples of firm leveraging these locations. And why this is relevant for sourcing leaders is that expanding into tier two and tier three cities gives sourcing professional a great opportunity to not only diversify their delivery footprint, but also refresh their supply base, leading to better pricing, stronger retention of talent, and more sustainable long-term growth. Uh, Moving on the next slide, before we move ahead with the next trends, just a quick heads up. We've got a little thank you gift for those who are attending today's webinar. Today's offer includes complimentary access to either of our two leading reports. To receive the complimentary reports, all you need to do is click in the link in the chat or let us know in the follow-up survey email. All right, let's now move to a topic that a lot of our clients are asking us about, which is how do I manage my mix of locations and suppliers effectively? With everything changing, be it talent dynamics, market saturation, and economic shifts, it's becoming essential to keep our portfolios aligned with our sourcing objectives. Now, I'll take a step back and look at how delivery models have changed over time. So, if I were to trace the transition, the portfolio model has evolved over the last decade from a traditional network of individual sites to the modern day efficient hub and spoke model. And what we have seen is most of the early adopters of global services, they earlier relied on establishing a network of individual sites. Now, each site here managed its operation relatively independently, managing its resources as well as the decision making process largely by itself. What this enabled is more localized control and quicker decision making process. However, it also introduced challenges in terms of ensuring standardization, resource allocation, and the collaboration among these sites. Now, as these individual sites grew more interconnected, the complexities in the service portfolio increased and the global linkages solidified, and the limitations of these traditional individual sites became more evident. We even recall some of the firms facing inefficiencies due to redundant processes, inconsistency in service quality, and a lack of centralized control over some of these critical operations. Now, as a result, we saw companies moving towards the right, which is the hub and spoke model. Now, this emerged as a strategic solution in the sense that you have the hub, which serves as a nucleus for decision making, and the spoke retaining some of the level of autonomy to cater to the local needs. But in terms of niche skills, language time zones, client proximity, and so on. Now, in addition to solving the problems that we just talked about, this also helps in creating operational resilience. So, if one spoke faces downtime and disruption, the overall network remains functional and the other spokes compensate for it. Now, the interesting thing here is that post pandemic, we have seen a further evolution of the incorporation of the additional satellites or tertiary sites into the overall portfolio. These are smaller distributed sites and satellites, which could be office pods or shared workspaces, and serve as the nodes that complement the overall hub and spoke model. And what we have seen is firms kind of positioning these nodes in key talent hubs so as to get access to skilled professionals and also provide some of the localized support. But here's what's interesting, and as we see on the next slide, in 2025, we are seeing a shift away from the satellite heavy models, and instead, firms are focusing more on consolidating their locations portfolios and turning key hubs into strategic center of excellence or COEs. Why? Because a highly fragmented model comes with challenges, such as retaining talent in small satellites is very difficult. Internal collaboration and communication can suffer with other sites, and quality, compliance, and employee engagement become really hard to manage. That said, what are companies doing instead? Now, many firms are now doubling down on portfolio consolidation, which is a more evolved version of the traditional hub and spoke model, and that is enhanced with a few strategic levers. These include scaling spoke location into full-fledged multi-hub operations and ensuring that the location has the feasibility to support that level of demand at the moment, as well as in the future. Now, firms can retain some of the cost-efficient spoke centers which offers flexibility in business continuity, however, at a relatively smaller scale, and transform the existing core hubs into specialized COEs. At the end, it's about finding that balance between scale and focus. And finally, let's talk about a tool that a lot of our clients are interested in, which is the Locations Portfolio Management Framework or LPMF. If we move to the next slide, this 2 by 2 matrix helps us answer one key question. Where should I invest more? Where should I hold steady? Or where should I maybe even scale back? Now, very quickly, this framework has two aspects, which is a 2 by 2 matrix. The x-axis is about the overall market. Here we have things like talent, infrastructure, business environment, and the y-axis talks about you and your competitiveness in the market, which is essentially your market share, how have you been growing, and this also talks about the ease of talent management, which is essentially your lead time to hire, how high or low is your attrition, and if you are considered as an employer of choice in the location. So when you combine the two, you get a good understanding of the health of the location in your global portfolio. And we have divided this into four quadrants. First is expand and grow, which is at the top right and says that you have to have a favorable position in the market, and the market itself has very strong fundamentals. So if a location in your portfolio stands in this zone, this basically means that you can add more type of work, you can scale an existing function, and potentially think of this as a location for the long term and start investing in this more in things like educational systems and the overall ecosystem, and consider this as a golden goose in your overall locations portfolio. Now, on the other hand, if you have a location which lands in the whole zone, which means your position is strong in the market, but the location fundamentals may not be very strong. Here, you would definitely would want to maintain your investment in the market and exploit your position of strength. But going forward, you might want to hold off on adding new work because the location offerings may not be very strong in itself. The third zone is watch and test, which is your position in the market may be great. However, the location fundamentals in itself are not very strong. Here, the market is doing really well, but you have not been able to tap into the market. So, if you need to improve your position in the market and consider ways through which you can leverage it better, maybe bringing in more leadership, improve the brand perception to attract more talent, and so on. And lastly, we have the shrink and exit zone, which is basically the market is not great and your position in the market isn't great as well, which means that there is an overall unfavorable environment and you may want to start reducing your operations or plan to radically descale the market. Now you can do this analysis at a location level or even by a function location combination like software development Hyderabad, contact center in Bogota, F&A services in Poland, and so on. This tool is super practical, and we recommend refreshing this every year or two to stay ahead. And with that, I'm going to hand it over to Bhanushi to share further insights on how sourcing leaders can make the right location choices.
All right. Thanks, Harshit. So I think the points that Harshit and Sumit have made have been all around the market, right? They've been telling you about the trends. We've given you a nice framework to fit your location strategies in. But a lot of times our clients have been asking us questions on, okay, we have all this information from you, but now what is it that we can do, right? What are the actions or sort of prescriptive steps that we can take as we go forward and understand these trends and actually apply these to our day-to-day strategies, right? So this is what the next section is all about. We want to give you a very actionable playbook so that you're able to make the right location choices in your overall supplier portfolio strategy. And what we're planning to do over here is, of course, we'll give you some examples, best practices. We'll also share some anecdotes from what we've seen across clients and strategies they've taken that have been successful in the past. We also recommend, by the way, I see the Q&A chat is a little less active than what I've seen usually. So we also recommend that if you have any anecdotes to share, or if you have any specific questions to ask us, then this is the time that you go ahead with them, right? Because this is where we can actually address what you can do on a day-to-day basis. All right. So with that, I think if we jump to the next slide, so these are the sort of sorry. I think what we'll do first is we'll start with a poll, and we want to understand from you as to what factors lead you to alter the locations mix in your outsourcing portfolio. And you can select a large number of options, right? So just gonna, I think there are a couple of options over here. Are you trying to achieve savings through labor arbitrage, total cost of operations, mitigate location concentration risks? Okay, I see that location concentration risk is a very popular option from the results I'm getting till now. You're looking at specialist skill needs, more time zone coverage, multilingual coverage, or just overall resilience, geographic diversification.
But Bhanushi, let me ask you, based on your guidance, what have you seen as the most recent, the factor which has gained the maximum traction in the, let's say, 1 to 2 years time frame out of all of these?
Yeah, I think that's a great question. And what I would say is that I've seen a balance of, so the first thing people come to us with is that they want to mitigate the location concentration risk, right?
Mm.
Which is because a lot of our clients, a lot of the, companies, large global companies have a lot of concentration in India, like you also mentioned, a lot of offshoring happening in India, a lot of offshoring happening, let's say in Philippines for specific processes. And they want to really mitigate the risk and move, let's say, near shore or to other geographies to ensure that service delivery coverage issue does not happen. So that's number one. But increasingly, or overall, I think it's always been sort of an evergreen factor, right? Cost optimization. So that has always been there, and it will continue to be there. People always will care about it. Emerging things, and I see over here that some people have also selected, specialist skill needs. So if we share the results with the audience, what they'll also see is that again, optimizing total cost. So, but is still the top factor, right? 79% of people have selected this, followed by I think getting, of course, savings through labor arbitrage, the prime reason we moved to offshore locations, and of course, balance between increasing talent accessibility, location concentration risks, and so on and so forth, right? Interesting. All right. I think this is a great, sort of validation for us as well to see these results and to understand that, okay, you all are also facing similar type of, challenges and you're thinking about altering your locations mix. So what we'll do now is sort of talk about more of strategies. If we move to the next page, we want to talk more about, the strategies that are there when it comes to how sourcing leaders can think about their supplier portfolio as a whole, right? So when we're getting asked the question that what should our location strategy be, there are actually a couple of ways that you think about it. And Harshit spoke a lot about the consolidation aspect, right? With the hub and spoke model and the consolidation that is becoming more and more popular. But there are also other ways that you can use to balance your supplier portfolio as a whole. So consolidating your portfolio, which means rationalizing the number of suppliers that are there. Typically, it helps you achieve a lot of cost savings, right? We've worked with organizations, they've moved from a set of 100 ADM vendors to a set of just two or three vendors, right? And we work with companies all the time who are actually making such large decisions and taking such large initiatives. So it's actually a huge sort of initiative that is very, sort of large. You have to work across business units, ensure there's no silos, and internal cost pressures are really managed through this. But there's also redistribution, right? So in that, what we're doing is that we're not altering the service provider mix at all, but what we're doing is just rebalancing work across delivery locations. And what that helps us do is just make sure that there's a better risk distribution. So to your point on, what was the most popular thing, mitigating concentration risk, right? That is really managed with this redistribution aspect, as well as other things such as, multilingual coverage, ensuring all your zones are covered, and sometimes even the specialist skill set aspect is addressed through this particular aspect, right? So redistribution is another strategy that we really see organizations take. And I think the last one, which is becoming more and more popular, is diversification. We've actually been doing studies for the past couple of years, and this particular factor, which means inclusion of new providers in alternate locations in your overall supplier portfolio, this is rising a lot. And the reason for that is because of the demand for next gen skills that really is rising with those new sort of Gen AI needs, your niche skill sets, your tech needs, and the overall talent accessibility needs or issues that have come up in the past, right? So diversification is a huge initiative that is being taken up by our clients, and it is actually helping solve a lot of problems across, of course, giving you access to more specialized talent, as well as moving to different types of locations and getting access to those tier 2 3 locations when you're not getting what you need in the tier 1 locations that you have. So with these three strategies, I also want to talk a little bit about a study that we're doing. This is on this concept, right? Looking at your supplier portfolio and just understanding what should be your supplier portfolio strategy. How many suppliers should you have in your mix? Is risk like optimally balanced within the mix? Do you have a proper, cost optimization within your supply base, and so on and so forth? So we have posted the link in the chat. For whoever is interested, please do take this survey, and we promise you that we'll share the overall results of what we find out from the market with you once you have completed it. It's an interesting study because it'll help you understand across the global services categories how you should be shaping up your supplier portfolio strategies. All right. So with that, I will hand it over to my colleague Khushbu, and she will be actually getting into the details of how you can move past the outdated playbooks that you have.
Thanks a lot, Bhanushi, for setting the context on how sourcing leaders see their supplier portfolio strategy primarily through three key lenses, which are consolidation, redistribution, and diversification. The obvious question, I believe, which will be in everybody's minds now is why now? what is forcing sourcing leaders to adopt these strategies more urgently than ever before? To answer that, we can zoom out and look at the macro level shifts which are reshaping the sourcing landscape. So, moving past the outdated playbooks, historically, our models were built around three basic assumptions. First one being labor arbitrage is always going to drive cost savings. Second being talent hubs are always stable and abundant. Third being we could manage risk as it came, be reactive about it. But these assumptions are cracking under pressure. We are in an AI driven era where automation is narrowing the cost gaps between locations, which is forcing a shift from cost first to value first strategies. We are also seeing talent sustainability, not just availability, become a core concern with sourcing leaders. So it's not just about hiring right now, but also building a pipeline that can support delivery, let's say 3 years from now or 5 years from now. And geopolitically speaking, also, we have seen how fragile our global footprints can be, from wars to trade restrictions to climate events. A narrow view of risk just is not cutting it out anymore. So, what is emerging right now is a very different mandate for sourcing, which is around future proofing delivery and not just optimizing it. So, with this context in place, we can now look at how leading organizations are responding. What are the new priorities which are shaping today's location strategies? So, if we move to the next slide, we are seeing a real shift in what organizations prioritize when evaluating delivery geographies. First, we are moving beyond cost to value driven sourcing, which means looking at the total cost of operations, not just wages, but also inflation exposure, attrition rates, supplier performance, and how well the location supports innovation or digital outcomes. Second, there is a rising emphasis on talent evolution and sustainability. Asking questions around, can your chosen city or country supply the digital business skills that you will need over the next 5 to 7 years? Can it retain them? Is it already overheated? Third, being organizations are also embedding resilience into their sourcing models. That includes proactive scenario planning for geopolitical shifts, avoiding over concentration in a single region, and having a backup plan before it's needed. Together, these three shifts are they are together reshaping how sourcing leaders structure their global delivery portfolios and how they are evaluating potential locations. So now we would be deep diving into the above three strategies, and we'll be looking into why it impacts sourcing, what are the common tactics sourcing can use to optimize them. So moving to the next slide and looking at beyond labor rates. Um, well, it starts with shifting from price only thinking to total cost of ownership, like I said. That includes assessing ramp up times, productivity, and service quality across different geographies. What we are also seeing organizations doing right now is that they are benchmarking supplier performance to ensure that they are getting market aligned results and tying contracts to business outcomes, like compliance speed or CX improvement, and not just FTE rates. Importantly, they are consolidating delivery footprints as well, not just to save money, but to increase alignment with strategic priorities. And they are actually asking tough questions to their suppliers, like, where is your innovation pipeline coming from? And how can you help me future proof delivery? So we have a pretty good case study over here as well, wherein a global CPG firm reviewed their global footprint, and they found redundancy in several overlapping mid-tier hubs. And by consolidating and shifting to better aligned nearshore centers, they were able to cut 15% of their delivery costs while actually improving SLA performance as well. So that is what we see as a power of data-led sourcing decisions. Moving to the next slide, where we would be, deep diving into talent sustainability. Uh, Sourcing leaders are no longer just reacting to skill shortages. They are actually designing for sustainability. That means they are expanding into tier 2 and tier 3 cities, not just to save money, but to access stable talent and with lower attrition and stronger graduate pipelines. It means using location specific talent benchmarking, understanding how long it takes to hire, how deep the digital talent pool is, and what the projected wage trends essentially look like. Um, and it also means, looking beyond the city size and thinking about academic ecosystems. Like, does the city have universities producing the right kind of talent? Is there a culture of upskilling? We have, another interesting case study out here, wherein one global bank was facing digital attrition issues in a saturated tier 1 city. And they made a strategic shift by diversifying into tier 2 cities across APAC and LATAM. And within a year, they reduced the churn and saw a notable productivity lift. So that's how we see the power of talent first and location design.
Yeah.
Khushbu,
And
just
finally,
to add on this one, actually, a very interesting theme that you touched upon, expanding into tier 2, 3 cities. Now, this has been on cards for years. We have been speaking, but an accelerated shift has started happening in the last 2 to 3 years, especially when we track the location workforce, multiple clients of ours, we both enterprises, providers, and currently in Europe, we are seeing a lot of traction in tier 2, 3 pockets. And that is not only driven by, actually, that is not driven by a lot of cost advantage, but more on the talent side, the talent sustainability, as you spoke. For example, in many of these European tier 2, 3 cities, we are seeing a strong collaboration happening between the academic institution and the enterprises over there so as to create a ready pipeline of graduates, which is very much helping many of the enterprises providers. Some of them have also mentioned that their experience of working in tier 2, 3 cities has been better in comparison to some of the tier ones, because in tier ones there is too much of a market congestion, too high of attrition rates to cater to. And yes, tier 2, 3 is on a rise. And by the way, I'm taking example for Europe, but it's happening globally. It's happening a lot in India, Philippines, everywhere. So nice to see this insight and look at into this case example as well, which resonates with this one.
yeah, of course, we see, even with conversations with our clients, Sumit, this is a very popular topic, and there is definitely a long-term focus on talent sustainability, and there are investments being made to it. So happy that it resonates with you as well. Going to the next slide now, where we'll be talking about the need to diversify delivery to mitigate concentration risks. Heavy reliance on a single geography is risky, right? Whether it's India, the Philippines, Eastern Europe, any region can face a disruption. And to manage that, we are seeing leading organizations adopt dual region or multi-shore models using location risk matrices to guide decisions and choosing suppliers with broad delivery footprints. In one case, we saw a multinational bank which flagged major exposure to one country. Their team ran a contingency assessment and selected two new hubs in other regions and shifted 30% of their work portfolio over 18 months. When that original hub later experienced political instability, they were pretty much protected. So, what we essentially gauge from this is that resilience is not just a buzzword, it's definitely a sourcing imperative. So, just to close this section, what we learn from all these insights is that today's sourcing playbook is defined by value, sustainability, and resilience. The leaders in this space are no longer asking, where can I cut costs? They are asking, how do I build a future ready delivery model? And of course, it all starts with making the right location choices. Now that we have explored how sourcing leaders are reshaping their strategies from portfolio moves to talent sustainability to resilience planning, but even the best design strategy needs the right governance to stick. Which brings us to the next critical piece of the playbook, which are control ratios. These are the operational guardrails that help sourcing leaders stay disciplined as they scale and evolve their delivery models. We would be deep diving into that in our next slide. Um, Bhanushi,
All
over to
right.
you.
Yeah. Thanks, Kushbu. So this is sort of, control ratios is a concept that you as an organization can think about when you look at your overall supplier portfolio, because this concept really helps you think from a broader or a more holistic lens, and it will help you enforce those guardrails for expanding, reducing, or making those overall portfolio strategy decisions, right? When you look at a large portfolio of suppliers, generally, if you have visibility on, let's say, the overall outsourcing that you have done, uh, one type of control ratio that you can think about is thinking about how much outsourcing do you want to do as a firm. How much risk are you comfortable with in terms of core and non-core operations? What are the types of processes that you wanted to outsource, and overall, what is the percentage that you feel is okay to be outsourced when you look at your overall spend? If you feel that currently you're at an 80% outsourcing model in terms of your global services delivery, but you would have probably been more comfortable at only, let's say, a 50-60%, then that is a very strategic decision that you need to make as an overall firm. That do you need to maybe, let's say, reduce your outsourcing and bring more work in house, or use some other type of global service delivery model that you're more comfortable with, right? And this is just for outsourcing, nothing against outsourcing here, but you need to think about this across all the type of areas that you have, right? It can also be in terms of how much spend you have with one supplier. If you're only concentrating all your work with, let's say, top three suppliers, and your first supplier has owning 90% of your spend, then maybe there is a chance that there's a you don't have enough competitive or rivalry, let's say, amongst top two suppliers, and the first supplier is not giving you the service delivery you expected, right? All hypothetical situations, but you may feel that you need to distribute or spend a little bit more, and then in that case you need to think about a control ratio, which will be similar to, let's say, no more than 70% of spend should be with the largest supplier. The rest of this 30% can be distributed amongst the rest of the suppliers, right? So these are the examples that I would probably just keep with you, right? Think about these things as you look at your overall supply portfolio. In a lot of cases, we've seen that just getting visibility and ensuring business alignment to make these type of strategic decisions becomes harder. And that is why we really recommend that there should be a proper, let's say, a governance mechanism in place, right? And we'll get to sort of the best practices as we move forward. But when you think about control ratios, think about all the aspects that can come into it. It can be across your location mix, of course. How much work do you want there to be offshore, nearshore versus onshore? Let's say, how much do you want to, keep spent in a single location? Or, of course, outsourcing. Or it could also be around, let's say, language preferences. That do you want to have specific language specific sort of multilingual coverage? Do you want more of multilingual coverage, less? More time zone coverage, less? So think about all these aspects when you look at your entire supplier portfolio. And with that, I think what we can do is we can move to the next slide, and it sort of brings us, to the end of this particular section as well, where we wanted to give you very actionable insights and things to do. And just summarizing, if we move to the next page, as to what are the top things that we would leave you with, right? As we close this particular webinar. So the first thing is align your location strategy with your business. One of the major challenge that we've seen across our clients is just business alignment and internal stakeholders, just getting them on the same page. So this is key. It's not just cost that you're looking at, right? There's a lot of there's not a pure labor arbitrage model. You're also looking at business priorities to be able to make the right decisions. So make sure that you have those mandates in place when you're thinking about these things. The next thing, which I think Khushbu was really focusing on, was building a future ready talent portfolio through location diversification. And the case that she shared at that point was really key, that you want to create access to more talent. You want to sort of look beyond tier one cities and look, let's say, at tier two, three cities, create more talent accessibility, because that will ultimately help you become more sustainable as a business model too. The third one is de-risking your delivery footprint, looking at your mitigation concentration risk, looking at multi-region strategies, right shoring models, going back to the control ratios concept. Are you looking at the right type of risks? Are you comfortable with the certain level of risk that you have currently? The next is clear setting those clear guardrails, having your control ratios in place. And all in all, what I would summarize with is that all of this depends on the governance and the alignment that you're able to create within your organization. So if you're looking at the overall tuning of your location mix, think about all the trends that are happening in the market, right? Think about everything that's going on in terms of delivery models, but just try to do what's also right for your particular organization. I think I'll just throw in a little example here and close this my sort of monologue. But it's been, there have been clients who've been reading our research and they've been talking about, let's say, tier two, tier three locations, and we've been moving to, we've been reading your research, looking at these locations. But the question we ask them is that the right model for you? And why are you thinking about tier two, tier three locations? Is it to create more access to talent? Is it to, let's say there are some skills that you're not able to find? Is it because you want to diversify your risks? What is the prime objective that you have, right? And so take all these trends with you, take all the information we're giving you, but really try to see what is the right fit for your business and then choose what works well, right? So I think with that, I close. And what I want to, push everyone's attention back to is that we do have this offer for everyone, right? This complimentary offer. We have two options for reports, very interesting reports, both of them. One is on talent demand trends, and another one is on making the right sort of location strategy for 2025, right? So you can choose any one of the reports. We'll again be, posting sort of the link to the offer in the chat. So do see if you want to, avail the offer. I mean, you should, because it's complimentary and it will help you get more connected to us. All right. With that, I think we can move to the questions that we have over here. And I'm just, I know that we've been answering a bunch of questions as we have sort of gone through the event. But let's see. Okay, so I think this question, or it's more like a comment actually, but Thomas is talking about talent in India, right? There is talent in India, but unlocking the talent level, right skills at the right time, in the right place, given the local talent market structure, which means that the supply is sort of lagging the digital skills demand. This is becoming a big challenge for him. All right, very interesting. I think this is a big challenge for everyone. Sumit, do you think you want to address this particular comment?
Sure. Thank you, Bhanushi. And yes, by the way, this is a challenge you will face in across all the geographies, especially when it comes to digital talent, niche tech talent, full stack development, all those type of roles. But specific to India, let's say, what we know about India is that India is a combination of, I think, six, seven tier one cities, maybe 15 to 20 tier 2 cities, and then there are so many tier 3 cities. So the answer will change depending on which tier of city you are currently present in. But typically, if you look India from a tech talent standpoint, and within tech, if we start looking at the likes of very complex niche roles, be it cybersecurity, AI, full stack development, or even the digital skills for that matter. India has been as hub location for most of the tech firms to scale the largest. And the experience of most of the companies have been that scaling in India, even to a desirable scale of, let's say, even 100 people, it's easier to do in India rather than in any other country. Now, that doesn't mean that India will have its own set of challenges or not. For example, if we are in a tier two or a tier three city in India, then scaling will be difficult because the talent might not have all the digital skill availability at that point in time. What typically is what typically many of the organizations have actually tried and tested in tier two, three markets is that they have trained the talent when they have onboarded the talent for digital skills. That might not be so much required in tier one cities. And within tier ones, we haven't heard a lot of challenge in hiring. There is a challenge in attrition, definitely. So retaining the talent is a challenge that we have heard. But within the tier ones, uh, it typically the demand is obviously very high, but supply is also quite robust in comparison to other countries globally.
Yeah, it's true. Agreed that the supply challenge, and I remember that, a couple of years back, the supply challenge was a lot more complicated. I feel it's still become a little simpler. The talent demand crisis have subsided and all those issues have gone, but it's still always trying to find the right skills at the right place is always a challenge.
And actually,
All right.
Manshi, what we are
Yeah.
actually seeing, we were tracking this space as well on the demand supply gap for digital talent in India. This was very high in 2021. 2022 was a period of entire the great resignation wave and talent war. But starting 2024, 2025, we have seen that this demand supply has come down in India, and we expect this to be at a similar level at least for the rest of 2025 and early 2026. So yes, and by the way, demand supply gap for digital talent in India compared to some of the nearshore options or even the large European hubs, the Latin America hubs, is the demand supply gap is lower in India. This is what we hear and see in the market.
Yeah, no, that's great insight actually, and that actually brings me to my next question. You mentioned nearshore, right? So, what do you, or maybe Harshit, you would be more, sort of well versed with answering this question. What do you think drives decision making towards nearshore geographies versus offshore geographies? Is it just related to mitigating your risks? Is it also related to finding the right talent? What is sort of special in the nearshore geographies that organizations find is more comfortable for their location portfolio strategies?
Yeah, yeah. And Balanchi, that's a great question. Let me explain this. So each sourcing model, be it offshore, nearshore, or even onshore for that case, depends on specific business priorities such as cost, time zone alignment, talent availability and scale, and finally, while key hubs such as India and Philippines remain unmatched in parameters such as cost savings and the scalability potential, to answer the question, the viability of continuing to source talent from nearshore locations such as nearshore Europe and Latin America remains strong. And in many cases, it increases strategically as well. And some of these cases are when time zone alignment is a priority, because nearshore regions, particularly LATAM for Northern American businesses and Eastern Europe for UK and Western European markets, offer the benefit of overlapping work hours. This enables real-time collaboration, faster turnaround times, and more agile development cycle. There's also an aspect of cultural and language affinity. So based on experience of some of our clients, and this is one of our clients we recently were collaborating with on our locations portfolio strategy. What we realize is that nearshore teams often has greater cultural and linguistic alignment, which enhances communication and supports smoother integration with the rest of the teams, be it internal as well as client teams. The third reason that nearshore remains vital is due to the talent quality and availability. So both nearshore Europe and LATAM have made significant investments in education and technology ecosystems to produce highly skilled talent pool in areas like digital skills, data analytics, and judgment-intensive business processes, and more. And finally, we have the geopolitical and regulatory considerations. So some locations in Asia, Europe present lower geopolitical risk for some businesses and offer more data privacy laws, especially which are aligning with the EU framework. To summarize, while offshore will play a vital role, nearshoring is also seen as a strategic complement, especially for firms prioritizing collaboration, more agility, and speed to market. Hope that answers the question.
Yeah, no, that's a great point, right? I think one of the major things our clients have also been talking about is the multilingual aspect of it. If you're looking for specific languages, you have to go to nearshore locations. It's very hard to find those in, sort of onshore, sorry, offshore locations. All right. I think what I will do is we probably move to the next question. We just have 3 minutes left, so only one question is what we'll be able to address. But we'll be happy to, also answer the remaining questions as a follow-up. Now, I think maybe what's your view on 100% remote working in India? Khushbu, would you like to talk about this?
Sure, Bhanushi. And I believe it's a very interesting question, right? Because 100% remote work is what we were trying to embrace during the pandemic. But however, having said that, basis our continuous conversations that we are having with organizations, we do see a move towards a more hybrid setup, especially keeping long-term delivery strategy in context. And some of the key reasons, when we ask leaders that what are their reasons around it, they focus on key elements such as talent, productivity, team level collaboration, real time coaching and onboarding, which was earlier, which slightly suffered in cases, especially for junior tech and BPO roles. So sourcing leaders are right now recognizing that the in-person interaction still plays a role in performance ramp up and retention. um uh, Also, talking about infrastructure variability, unlike some other global markets, connectivity, power reliability, dedicated home office setups, they can still be inconsistent. I know we have, made quite a, leap in the digital headspace, but there is still room for improvement, which makes the case for hybrid setup even stronger. So, these are some of the intentional reasons which are pretty dominant in discussions with clients when we talk about working models.
Great. All right, thank you. I think this was a great answer and agree with you, right? There's different types of models, but hybrid seems to be working best. Uh, what I think we're at is the end of time, and I think it was a great session. Thank you everyone for joining, and do look forward to the recording as you'll be getting it within the next 24 to 48 hours. Just pointing out that we have we have our flagship event which happens in Dallas every year, right? Scheduled September 8th to 10th. So do see if you want to check it out, register. It's for various types of attendees, and we're focusing a lot on business services and tech. All right. I think we're at time. So just a couple of links for you. You'll be getting these in the recording. But thank you everyone for joining today. Great discussion.